Hi there, and in this session we're going to be looking at how to monitor a company's fundamentals in a little bit more detail, because when you're looking to invest in a stock or a firm, you really want to get a bit of a flavour of what the future holds for this firm. Is it things looking quite rosy? Is there some dark clouds on the horizon? You want to get to a bit more of an understanding in regards to what the facts and figures mean, and just to try and give you a bit of an idea about how you can evaluate a company's growth potential. So one of the first things you want to look at is, how is it the company is looking to go ahead and grow its business? Do they have any big contract wins coming up? Do they have any partnerships on the horizon? Do they have new products that they want to go ahead and release to the market? So you're trying to get a bit of a flavour of what is going to go and happen next with the release of these products, the release of these figures, and can that ultimately lead to extra growth for the actual firm? One thing you can also look at as well is there any possibility of rising prices for this particular company? Let's take, for example, mining companies. If you believe that commodity prices are going to go up in the future, it means these mining companies are able to charge potentially a higher price further on down the line, which could mean higher margins. So that's a very interesting element to look at. What is the propensity to be able to offer higher prices in the future, and are consumers willing to pay those higher prices? One other thing that you can also have a look at is how much cost control a particular company has. Typically you want to have a look to see what their marketing budgets are, what their staff costs are, and any intellectual property price elements that they have on there, and is there any propensity to actually go ahead and cut these prices and save money? Obviously if a company saves money, that can help them achieve extra growth there as well. So that gives you a bit of an idea of what to expect for growth anticipation. Can they cut their costs? Can they charge higher prices in the future? And what opportunity do they actually have to grow their business? So that gives you a bit of a flavour of what to expect at the beginning. The next thing that we're going to have a look at is in regards to, is there a risk of potential disappointment for this firm? There's maybe about 7 or so factors that you really want to have a bit more of a flavour about. The first one is operational risks. Okay, what are the competitors doing? Could there be any price wars? Could there be changes in costs? Are margins going to go ahead and get cut? What are the operational risks to the business? Are they going to have a product that comes out that perhaps doesn't perform quite as well as expected? So that's a very important one to look at. Another thing to think about is political risk. Is there any potential tax rate hikes? Is there going to be any levies to a particular firm? The banking industry right now is a particular one to think about in regard to political risk. They've had extra tax and bonuses, they've had levies put against them, they're having extra revenue streams cut there as well, so a very important one to look at, and can come out of nowhere sometimes, especially when there's lots of economic strife out there. Another factor to look at in regards to firms are the legal risks. Is there any danger that the firm could get sued? If you have a bit of a think about, say a technology firm, maybe a firm dealing in smartphones or mobile phones, for example, and there could be some patent issues that might pop out, and there could be extra payments that have to get made to other firms. So legal risks are always worth looking at in more detail. One thing you want to think about as well is in regards to currency risk. If you're dealing with international companies, they do business all over the world. Where are they keeping their money, and in what currency? If they're keeping all their money in sterling, for example, and then the sterling drops in value quite significantly, that has a massive effect on their bottom line doing business in other parts of the world. We see it happen quite a lot with a lot of Japanese firms. If the Japanese yen is dropping in value quite a lot, some of these Japanese firms that obviously keep all their money in Japanese yen are seeing their profits, even though their profits might be increasing, in real terms across the rest of the world, it could actually be shrinking. So that's quite important to think about. And a major big one, what is its risks of bankruptcy? If things really aren't going well, especially if you're looking for a very, very undervalued stock or share that you want to get involved in right now, hopefully anticipating it's going to increase in the future, is there any danger of bankruptcy? So that gives you a bit of an idea of what to expect in regards to having a risk of disappointing figures out there. The next thing that we want to go ahead and look at is exactly how does the market measure growth? And there's 2 ways that a market can go ahead and measure growth. We can utilize what's called a PE ratio, or price to earnings ratio. There's also a PEG ratio, which is price to earnings growth. And the PE ratio is calculated by taking the share price and you divide that by its earnings per share. That's quite an interesting one. You then take that figure and you can utilize that to calculate the PEG ratio. You take the current PE ratio and you divide that by the current earnings growth. Now, when you've got your PE ratio and your PEG ratio there together, if you can divide those two between each other, you're looking for a number of round about 1. Okay, so if your PEG ratio is around about 1, that's pretty much the standard. If the PEG ratio is above 1, that means that the market is potentially overvaluing that particular stock, or they're anticipating greater growth in the future. If you've got a PEG ratio less than 1, that potentially means the company is undervalued, and its PEG ratios of under 1, that can be that little bit more exciting. So that is typically how the markets value growth in the actual marketplace itself. If we then have a look at the next area, which is in regards to dividends, this one's quite an important one. What is a dividend? A dividend is a cash sum paid to an investor in regards to holding the share. Dividends massively important. If a firm is willing to pay a dividend, that usually means that they're making that little bit of extra profit on there. And depending on what dividend yield they actually give, gives you a bit of a flavour as to the potential profitability in the future. If a firm pays a higher dividend, it means they are more attractive to investors because then they earn more interest for holding the share. The lower the dividend payment, then people are potentially looking at a little bit more for capital growth. Typically, firms that offer a higher dividend yield are firms that are performing very, very strongly. So they make lots of profit, they can afford to pay shareholders that little bit extra money. Firms that are paying either a very low dividend yield, that could be because their business isn't really doing that well. They've got to allocate more money to keeping the business afloat rather than just going ahead to give money to shareholders. One thing being is some shares pay a low dividend, but that's because they've got very, very strong economic growth out there as well. One thing also to be aware of is if a firm doesn't pay a dividend or was paying a dividend then cuts it, that can be quite a good sign that the company is not doing very well at all. And typically investors, if they're used to getting a dividend and then you take that away from them, typically then they can bail from that stock and you can see quite a negative impact on the share price. So dividends, perhaps a little bit more important than you think, and try and think about the political reasons for either adding to a dividend or reducing a dividend. What does it say about the inner mechanics of an actual firm as well? Okay, so the next area that we want to look at is investing round about earnings reports. Now, earnings reports are well publicised and are usually known in advance, usually when big firms come out with how much profit they've made or how much money that they've got and lost there. And typically you've got a lot of analysts from all over the world. They'll give their opinions as to what they believe that earnings report might actually come out with. Okay, so you've got the actual real figures and then you've got the analysts think. When the results actually do come out, what you tend to see is a lot of that analyst reporting is already priced into the actual product that you're trading. So typically if they think a company is going to do particularly well, usually the company's share price is already ticked up that little bit. When the actual earnings report comes out, if it is following consensus, so yeah, they beat expectations, but they got to exactly the same expectations as what the analysts were expecting, normally you don't expect there to be that much share price movement. If the report comes out and it's dramatically different from the consensus in the market, that's when you can get some quite wild swings out there, and that can be quite an interesting time to get involved in the actual market itself. Sometimes, just before the earnings reports come out, there can be a little bit of anticipation that it's either going to meet or be lower than forecast, and typically, just before the results come out, if you see the price begin to tick up that little bit, that's telling you the anticipation is that the results are going to be better than expected. If you see the price tick down that little bit, that's the expectations maybe that, well, maybe their earnings report isn't going to be that good. Where the big price swings come from is if there's an anticipation that the figure's going to be better than expected and then they come out worse than expected, typically then you'll see that really big move in the market. So just be very careful out there when investing around those earnings reports. The last thing that we want to go ahead and have a look at is in regards to investing round about takeover bids. Typically, when one firm bids for another, the firm that is doing the taking over, sometimes its share price can get that little bit jittery, okay? And that's because there's a lot of questions that have to be answered, such as, are they paying too much for it? Is there any risk that the takeover bid might not be that good? Is there a risk that the synergies, typically firms take over each other because of synergies, is there a risk that the synergies might not be as good as expected? So there's that little bit of uncertainty. The firm that's getting taken over, however, usually its share price then dramatically increases in value. If it's a friendly takeover, it's not actually that dramatic. There might be, typically if it's a friendly takeover, the firm pays the actual market price. If it's a hostile takeover, then typically they pay over the odds for the actual investment. And what can happen is you can get other bidders involved in the process as well, so there can be a lot of volatility around that area. So one thing to be careful of is rumours of takeovers, okay? It's one thing about being involved when there is a takeover, but when rumours of takeovers come out, because if there's a rumour that comes out, share prices can dramatically increase, but then if the rumour turns out to be false, they can very, very quickly drop in value. So that is one thing to be very, very careful of as investing around about these times. But if you're lucky enough to get involved in the product just before there is a takeover announcement, fingers crossed, you should get some quite serious capital growth on your investment. And that is fundamentals behind companies.